Hello. In this chapter, we introduce the four inventory cost flows method. Our learning objective is very simple. In this chapter, we determine the amount of goods, cost of goods sold, and ending inventory using the FEFO and FLIFO, weighted average and specific identification cost flow methods. And I will explain the importance of inventory turnover to a company's profitability. Learning objective 1 determines the amount of cost of goods sold and ending inventory using the different method of inventory. So, inventory the cost flow method records that when the goods are sold, the production cost flow or are transferred from the inventory account to the cost of goods sold account. The four acceptable method is to determine the amount of cost to transfer a specific identification, first in, first out, last in, first out, and weighted average cost methods. So what does it mean, the specific identification? When a company's inventory consists of many high price, low turnover goods, the record keeping necessary to use a specific identification is more practical. Assume that the companies have two identical inventory items, the first for 100 euro and the second for 110. So if we use the specific identification, when the first item is sold, the cost of goods sold would be 100 euro. When the second item is sold, the cost of goods sold should be 110. Right? And now the second, first in, first out, or FEFO, the first in, first out cost flow methods requires that the cost of items purchased first should be assigned as the cost of goods sold. Assume that the TMBC company purchased two identical inventory items, the first for 100 and the second for 100 and 110. Using the first in, first out, the cost assigned to the first item sold should be 100. The first cost in, the cost of goods sold assigned to the second item should be 110. Now for the last in and first out, the last in and first out cost flow methods requires that the cost of the item purchased last be assigned to cost of goods sold. So what does it mean? Assume that the company's TMBC purchased two identical inventories items, the first for 100 and the second for 110. Using last in, first out, the cost assigned to the first item so would be 110. The last cost in, the cost of goods sold assigned to the second item so would be 100. So another method we call it the weighted average cost of goods sold. This the weighted average cost flow method assign the average cost of the item available to cost of goods sold. Assume a TMC company purchased two identical inventory items, the first for 100 and the second for 110. Using the weighted average, the cost assigned to the first item sold would be 105. The average cost is 100 plus 110 divided by two items, so we have 105. So using the weight, the average the cost assigned to the first item, so would be 105. The average cost is determined by taking the cost of inventory on hand and dividing by the total number of units on hand. So we already discussed now about the physical flow. Our discussion about inventory's cost flow methods pertain to the flow of cost through the accounting records, not the actual physical flow of goods. The cost flow can be done on a different basis than physical flow. So now we will take a minute to review the effect of cost flow on income statement. The cost flow methods a company uses can significantly affect the gross margin reported in the income statement. For example, if we sell the first product at the first in and first out and the price is 120, the sale price 120 per unit, we will use the cost of goods sold for the first in first out, so the gross margin should be 20 because now the cost of goods sold is 100. But if we use the last in first out, the cost of goods sold should be 110 and we have a gross margin of 10 euro. But if we use the weighted average cost, so we have a gross margin is 15. So we can say that the cost flow methods a company uses can significantly affect the gross margin reported in the income statement. Now we look at the effect of cost flow on balance sheet, right? Since the total product costs are allocated between cost of goods sold and ending inventory, the cost flow method used affects its balance sheet as well. So now by the end of the period, you have the ending inventory between the FEFO is 110 while the FLFO and FIFO of 100 and weighted average of 105. So you can see that the total asset of the company may not the same, right? So now this exhibit illustrates the relative use of different cost flow methods among companies in the United States. So for the average is 19%, for the FEFO is 35% and ABFO is 42% and other method is 4%. Now we come to the second part. We will learn the importance of inventory turns over to a company's profitability. The inventory's turnover ratio measures how quickly a company sells its merchandise inventory. It is calculated as the cost of goods sold divided by inventory. This is the first step in calculating the average number of days to sell inventory. The average number of days to sell inventory measures how many days on average it takes to sell inventory. It is calculated as 365 days per year divided by the inventory's turnover. Other things being equal, the company is a lower average of inventory turnover number of days to sell the inventory is doing better, so the lower number is better. Now this exhibit shows the average number of days to sell the inventories for 8 real world companies in the 3 different industries. So why industries take longer to sell its inventory than the other? Why quality wise is aged before it is sold? Time spent in inventory is actually a part of the production process. Generally, the longer while spent in the etching process, the higher the quality. Notice that the Starbucks holds its inventory of coffee longer than Yum brand and McDonald's, while it is more difficult for Starbucks to obtain coffee than it is for the other two to obtain flour, cheese, and fresh vegetables. Coffee is grown and harvested seasonally and requires substantial delivery time. As a result, Starbucks must hold inventory longer than McDonald's and Yum brand. See if you can come up with some explanation for the difference in inventory turnover between the department store industry and the fast food industry, right? Okay. So thank you very much for your kind attention. In this chapter, we introduce for inventory cost flow method, the specific identification, the first in, first out, last in, first out, and the weighted average. And we see how it affects to the company's income statement, like and balance sheet, and also we learn how to calculate the inventory turnover and also the average number of days to sell inventory. Thank you and hope to see you in the next video.